What is the VIX? Ever heard of the Fear Index? It's called the VIX, and it plays a crucial role in understanding market volatility. But what exactly is the VIX, and how does it work? Let's break it down. Welcome to the channel. My name is Anthony Gismondi, Senior Wealth Advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What is the VIX and why does it matter? The VIX, or the CBOE Volatility Index, is a real-time measure of expected market volatility for the next 30 days. It was introduced by the Chicago Board Options Exchange, CBOE, in 1993 and is often referred to as the market's fear gauge. But why does this matter? Because volatility is a key indicator of market uncertainty. When the VIX is low, the markets are stable and investors are confident. When the VIX spikes, fear takes over and investors expect turbulent times ahead. Historically, the VIX has surged during financial crisis. In 2008, during the global financial crisis, the VIX hit a record high of over 80. In March 2020, as the COVID-19 pandemic rattled markets, the VIX spiked to 82. These extreme levels signal panic in the market and indicate high levels of uncertainty. How does the VIX work? So how is the VIX calculated? It's based on the prices of S&P 500 index options. When traders expect big moves in the market, they buy more options, increasing implied volatility. The VIX aggregates this data and translates it into a single number. Essentially, it tells us how volatile investors expect the market to be in the next 30 days. A low VIX, typically below 15, suggests a calm and stable market. Between 15 and 25, we see some moderate volatility. When the VIX climbs above 30, it signals high uncertainty, and investors may start pulling back. A VIX above 40 often indicates a market in turmoil. But remember, the VIX isn't a crystal ball. It's an estimate, not a guarantee. The VIX isn't just a market indicator, it's also a trading tool. While you can't buy the VIX like a stock, you can trade VIX-related products, including VIX futures, contracts speculating on the future volatility levels, VIX options, derivatives that allow traders to hedge against volatility, VIX ETFs, and ETNs. These are exchange-traded funds and notes that track VIX movements. Hedge funds and institutional investors use the VIX to manage risk. If they believe volatility will rise, they might buy VIX options as protection. Retail investors can also use VIX ETFs to hedge their portfolios, but be cautious. Trading the VIX is highly speculative and requires a deep understanding of market trends. Since the VIX can experience extreme fluctuations, it's not a tool for beginners. VIX-related investments can be volatile, and many traders use them for short-term speculation rather than long-term investing. The VIX is a powerful market indicator, helping investors gauge fear and uncertainty. But like any financial tool, it should be used wisely. Want to learn more about market strategies? Hit that subscribe button and let's keep exploring.